Today, we're going to continue the discussion on how the money flows in the world are now dramatically changing. As we know, we all felt on this channel that since Liberation Day, that the big asset managers, sovereign funds in the world are reallocating away from dollars over a longer period of time. We think it's going to be at least 5 years, if not longer. We've had many stories, we've gone on over them on this channel, and this, I think, is absolutely happening. The second thing is that when we import, we export dollars to the exporters to us. Those dollars are normally invested in the US dollar and eventually into US treasuries as the reserve currency. Now, I know what's going on with Trump with 50% in Europe and all this other stuff. And we've said on this channel from day one, don't pay attention to this, but look at the long term. And it seems, at least in my opinion, you can argue with it about all you want, that some countries are going to end up with 25%. One's going to end up with more. China, they say, is basically a 49% tariff right now. And everyone else is going to end up with 10%. This is a huge reduction in trade in the world, which means, that's something that you can argue about all you want. What I want to talk about is that's a huge reduction in dollars going out to the exporters and a huge reduction of their ability to buy more treasuries. Now, we're sending to these countries, and we have stated in the Moran papers that we're going to expropriate your treasuries if they're here in the United States. And if they're not here in the United States, we're going to impose a tax on them, okay, of up to 30%. So people are moving away. So in other words, the total demand that we had for the dollar and meaning treasuries is now been reduced, okay? Now, all these moves in the world are causing trouble for each individual country, even though the problems are basically the same. If we tariff an exporter nation, that means that they then have less exports, and down goes their economy. So they want to lower their interest rates so that they can goose their economy to overcome the tariffs that we have put on them, all right? So it makes total sense. But here's the problem. We are seeing all the countries' long bonds going up in yield and down in price. And this is now causing major countries like Japan to reallocate their own internal dynamics of investing. And what do I mean by this? Okay, so over the weekend, Japan lost its status as the world's largest creditor, right? You go, okay, who cares? Who's now? Well, Germany. And what does that mean? Well, they have this thing called the Net International Investment Position, NIIP, and this has now shown that Germany now has a larger creditor status than Japan for the first time since 1991. Anybody who follows this channel knows that we put great import on data points that are 10, 20, 25, this is 35 years, okay? For 35 years, Japan has been number one, all right? And now they're not. And what does this actually mean? And then the first paragraph, the last sentence, and he goes through it, it's a tectonic shift beneath the surface of the global financial system. And this affects the world's capital flows, debt structures, geographical leverage points, and could have massive second-order consequences. What do we mean by second-order consequences? So if you print a lot of money, the second order is that you get inflation. The third thing, you get currency devaluation. The fourth order is you get social unrest, okay? 1, 2, 3, 4. That's what it means. So in other words, we're looking at what are the consequences of this happening. And you can see here We know that the Japanese rates are going up, but the second paragraph is the insurers, pension funds, and mega banks are reducing foreign exposure. This is what we talked about. The big asset managers are pulling back from the dollar. And they say it means fewer buyers of U.S. debt and more strain on our debt financing, which is what we've been talking about. But here, remember our video from last week saying, what are the Hobson choices? Well, they say Japan is caught in a trilemma. It can't simultaneously cap their yields, defend the yen, and sustain foreign capital exports. With the yen under pressure, briefly touching 160 to the dollar, Japan is being forced to reprioritize domestic solvency. Now, again, they go into this and they talk about how it means reduced buyers of treasuries, which we've been talking about for about 2 months now. And it means less global liquidity. Now, Germany overtaking Japan is not a sign of strength for Germany. We have done several videos now on Europe and Germany. And Germany, they invested like, I forget what it was like, $65 billion in plant and equipment, and like $55 billion was in the United States because of our cheap gas prices, all right? So that's where it shows that it's about stagnation in Europe. So they're taking their money saying there's no place to invest it here, let's go invest it elsewhere. So it's not about that Germany's doing so great that they're now the best creditor nation. That's the only point I want to make. So because of the tariffs we're imposing, the surplus nations, the exporter nations, are now repatriating their capital, because what they're doing is they're selling our treasuries so they can come back and defend their currencies or pump their economy. They have to do both in many, many cases. They need their own money. So as the last paragraph says, this is seismic stress fracture in the foundation of the modern global order, all right? So we had Japan at the top creditor, and that is now going away. So now we have to ask ourselves, is the surplus recycling, particularly U.S. debt markets, can we function without it? That's what we have to find out. No one knows. So what are the things we have to look for? Well, we're already watching, everyone is are people selling their treasuries to bring home to defend their currency, all right? So everyone's watching that already. We're also watching the global bond complex, long end, all rising when everyone thinks it should be falling, but they're going up. Now look at, people are arguing why that the long end's going up, why the Japanese or why the US is going up. I don't think anyone knows. I mean, we're just in one of those times when we have to kind of work through the cycle before we get there. But we're starting to see the governments coming out and making statements that tell us that, well, at minimum, the governments are really worried. Look what the Japanese are facing here. Their JGBs have raised 45% of their value since 2019. And these are massive losses for their banks and life insurers, just like we saw in Taiwan a couple of weeks ago. So again, how do the Japanese and defend their currency? They can't do it with their own paper. They're going to have to sell our paper. That's the point. And the Ministry of Finance has come out and said they're thinking about tweaking the composition of their bond issuance plan, trimming the issuance of long-term debt. So you can see what they're thinking here, right? What they're saying is if we don't issue any more long-term JGBs, maybe the price won't rise as much. And this is what Yellen did, which Bessent attacked her mercilessly on. Now Bessent has now have a more normal auctions that are going out, but we're seeing what's happening with our auctions. We're not making it, right? Our bonds are going up in price because of this. And even the UK is saying, listen, we are under such pressure that we can no longer really issue long-term gilts because no one wants them. Imagine you're buying U.S. government bonds to be your leverage in all your other investments. You don't want to buy something that's going down in value. So how do we come out of this? What do you think? Tell me in the comments and like and follow.